October 19th, 1987. 6 hours. That's all it took for Wall Street to lose 22% of its value. In a single trading day, $500 billion simply vanished. To put that in perspective, that's more than the entire GDP of most countries at the time. But here's what haunts financial historians. Nobody saw it coming. No bank collapsed the week before. No country defaulted on its debt. No major corporation went bankrupt. The economy was growing. Corporate profits were up. Unemployment was down. By every measure, the market should have been fine. So what caused the single largest one-day percentage drop in stock market history? The answer is more disturbing than a computer glitch or mass hysteria. Because what happened on Black Monday wasn't just a crash. It was the day the machines turned against us. And we invited them in. In the 1920s, the stock market crash took weeks to unfold. Investors had time to react, time to think. But in 1987, the entire collapse happened faster than a single workday. Traders arrived that morning with no idea their world was about to end. By lunch, fortunes were destroyed. By closing bell, the financial system itself was on the brink. The terrifying part? The people who created the systems that caused the crash thought they were making the market safer. Nobel Prize-level thinkers, mathematical geniuses, computer scientists at the cutting edge. They built sophisticated programs designed to protect investors from losses. And those very same programs nearly destroyed capitalism itself. This isn't about greed or corruption. This is about something far more relevant today. What happens when we let algorithms make decisions faster than humans can understand them? What happens when we optimize for efficiency and forget about stability? What happens when safety mechanisms become the very thing that destroys us? The same technology that caused Black Monday, the same blind faith in automated systems, the same mathematical models that failed so catastrophically, they're all back. Bigger, faster, more powerful. And this time, they control trillions, not billions. The story of Black Monday doesn't have a traditional villain. There's no Bernie Madoff figure, no Enron executives' cooking books. Instead, brilliant people made reasonable decisions that combined in unreasonable ways. First, Fisher Black and Myron Scholes. By 1987, their work on options pricing had transformed Wall Street. The Black-Scholes model gave traders mathematical certainty in an uncertain world. Scholes would later win the Nobel Prize. But their model had assumptions about how markets behave that would prove catastrophically wrong. Then the portfolio insurers. Leland O'Brien Rubenstein Associates pioneered a seductive idea: insure your stock portfolio like you insure your house. Hayne Leland and Mark Rubenstein were Berkeley professors who believed they'd found a way to protect investors from downside risk using dynamic hedging. Their clients included the largest pension funds in the world. By October 1987, portfolio insurance strategies controlled $90 billion. Leo Melamed, chairman of the Chicago Mercantile Exchange, had spent years building the futures market. This innovation was supposed to make markets more efficient, more stable. Instead, it created a bridge between markets that would transmit panic at the speed of light. John Phelan, chairman of the New York Stock Exchange, would face an impossible choice on Black Monday: keep markets open and watch the system potentially collapse, or close them and destroy faith in American capitalism. But the most important character isn't a person. It's the computer. By 1987, program trading had become dominant. Firms used sophisticated algorithms to execute trades automatically. These programs could buy or sell millions in seconds, far faster than any human. They were efficient, precise, and utterly ruthless. On October 19th, they would all activate at once. To understand Black Monday, you need to know that 1987 wasn't supposed to be a crisis year. It was supposed to be a celebration. The bull market that began in 1982 had been running for 5 years. The Dow had more than tripled. After the dark 70s with their stagflation and oil shocks, America was back. Ronald Reagan was preaching deregulation and free markets. Wall Street was booming. But underneath, the foundation was cracking. The United States was running massive deficits. The federal budget had exploded under tax cuts and military spending. The trade deficit with Japan and Germany was setting records. The dollar was falling. These represented fundamental imbalances in the global economy. Interest rates were rising. Paul Volcker had been replaced by Alan Greenspan in August of 1987. Greenspan was barely 2 months into the job when Black Monday hit. The Fed was trying to keep the economy growing while preventing inflation, raising rates slowly but steadily. But the real revolution was in how markets operated. The 1980s saw an explosion of financial innovation. Stock index futures, introduced in 1982, allowed investors to bet on the overall market direction. Options trading was mainstream. Junk bonds were financing corporate raiders. And computer technology was transforming trade execution. Program trading was the new frontier. Investment firms could write programs that automatically bought or sold large stock baskets based on mathematical formulas. If certain conditions were met, the program executed trades without human intervention. This was seen as progress, efficiency, rational application of technology. Portfolio insurance was the crown jewel. The concept was simple. Use computer programs to automatically sell stocks or futures when markets declined, limiting losses. As the market fell, the program sold more. If it rebounded, the program bought back in. It was dynamic, sophisticated, backed by rigorous mathematics. What nobody appreciated was that portfolio insurance only worked if you could execute the trades. If the market fell slowly, if there were buyers, if the system had liquidity to absorb selling pressure, then yes, it worked. But what if everyone was trying to sell at once? What if the market fell so fast you couldn't execute orders? What if the portfolio insurance programs were causing the very decline they were designed to protect against? These weren't hypothetical questions. They were engineering problems that should have been solved before deployment. But Wall Street, intoxicated by the bull market and dazzled by mathematics, didn't ask them. By October 1987, $90 billion in assets were protected by portfolio insurance. That was a significant portion of the institutional market. And all these programs had similar triggers. They would all start selling at roughly the same time if the market dropped significantly. It was a bomb, carefully constructed by the smartest people in finance, placed directly under the stock market. All it needed was a spark. The market had been volatile in preceding weeks. Treasury Secretary James Baker made comments about the dollar that spooked markets. There was talk of legislation to curb corporate takeovers. Interest rates kept creeping up. On Wednesday, October 14th, the market dropped 95 points. Thursday, it fell 58 more. Friday, October 16th, was worse. The Dow dropped 108 points. Volume was enormous. Program trading was clearly active, with massive automated sell orders hitting the market. But Friday's close told a different story most people missed. While New York was closing, Asian markets were opening. And they were falling. Hong Kong, Tokyo, Sydney. By the time Asian markets closed, they'd seen significant declines. Sunday, October 18th, traders worldwide looked at screens and realized something terrifying. There was a massive queue of sell orders for Monday's open. The Asian declines meant portfolio insurance programs around the world would trigger at market open. And there was no way to stop it. Monday, October 19th, 1987, begins before most Americans are awake. In Hong Kong, the Hang Seng Index is already in free fall, down 11%. In London, the FTSE is dropping rapidly. The wave is moving west, following the sun, carrying panic across time zones. In Chicago, the futures market opens at 8:30 a.m. Eastern, 30 minutes before New York. Stock index futures are a leading indicator of sentiment. The Chicago market opens down dramatically. The selling is immediate and intense. The S&P 500 futures contract is plummeting. This is the first domino. Portfolio insurance programs are watching these futures prices. Their algorithms have predetermined triggers. When losses hit certain thresholds, they automatically sell either stocks or more futures to hedge positions. As futures fall in Chicago, programs start activating. New York opens at 9:30. The Dow immediately gaps down. Not a gradual decline, but an instant drop. The specialists on the exchange floor, whose job is maintaining orderly markets, are overwhelmed from the opening bell. By 10 a.m., the Dow is down 100 points. Already a terrible day. But it's just beginning. Here's where the feedback loop starts. Portfolio insurance programs are selling in both markets, stocks in New York and futures in Chicago. Each sale pushes prices lower. Lower prices trigger more portfolio insurance selling. More selling pushes prices even lower. It's a death spiral happening faster than humans can process. Traders are screaming. Phone lines are jammed. Computer systems are overloading. The sheer volume of sell orders is unprecedented. Under normal circumstances, market orders execute within seconds. But today, orders are taking 30 minutes, 45 minutes, an hour to fill. And during that time, prices are collapsing. This creates a new problem. The portfolio insurance models assume quick execution at known prices. But with delays, not knowing what price you'll get, the models break down. So programs compensate by selling even more, trying to achieve their hedge ratios. It's like trying to stop a car with broken brakes by pressing harder. By 11 a.m., the Dow is down 200 points. Panic spreads beyond Wall Street. CNN broadcasts the carnage live. Investors across America watch their retirements evaporate in real time. The Chicago futures market is in complete chaos. The S&P futures are trading at enormous discounts to the actual stocks. In a rational market, this shouldn't happen. Arbitrageurs should buy cheap futures and sell expensive stocks, bringing prices back in line. But today, they can't execute trades fast enough. The systems are overwhelmed. So futures keep falling, sending false signals of even deeper panic. Portfolio insurance programs see falling futures and sell more stocks in New York. New York's declining stocks trigger more futures selling in Chicago. The two markets are locked in a death embrace, dragging each other down. By noon, people are using words like catastrophe and meltdown. The Dow is down 300 points. Percentage-wise, this is already worse than any single day during the 1929 crash. John Phelan faces a decision that will define his career. He can halt trading, close the market. This would stop the bleeding, give everyone time to breathe. But closing the market has never been done in response to a decline like this. It would signal complete loss of control. And when would you reopen? What if selling pressure is worse the next day? Phelan decides to keep the market open. It's a gamble. The afternoon is when things get truly apocalyptic. By 1 p.m., the Dow is down 400 points. Specialists on the floor face a nightmare. Their job is maintaining orderly markets by buying when everyone sells. But today, the selling is so intense that many specialists are running out of capital. If they go bankrupt, the market-making system collapses. Trading ceases. The market literally stops functioning. The Federal Reserve watches with horror. Alan Greenspan is on a plane from Dallas getting updates by radio. If the specialists fail, if the market stops functioning, it could trigger a bank crisis. Banks have lent money using stocks as collateral. If those stocks become worthless or can't be valued because the market isn't operating, the banking system could freeze. It would be 1933 all over again. The portfolio insurance programs are still selling. They're designed to be emotionless, to follow algorithms regardless of conditions. And their algorithms say sell. So they sell into a market with no buyers. They sell to specialists who are nearly bankrupt. They sell until there's nothing left. By 2 p.m., the Dow is down 500 points. The percentage decline is approaching 20%. This is worse than Black Thursday in 1929. This is worse than any single day in American financial history. And then something shifts. It's not clear what causes it. Maybe bargain hunters decide stocks are too cheap. Maybe some portfolio insurance programs reach the end of their selling. Maybe it's just exhaustion. But the free fall slows. Not stops, not reverses, just slows. The last hour is still brutal, but the pace eases. When the closing bell rings at 4 p.m., the Dow has fallen 508 points, 22.6%. In 6.5 hours, the stock market has lost more value than during any week of the Great Depression. $500 billion has vanished. Pension funds are devastated. Retirement accounts shattered. Fortunes built over decades destroyed in hours. But the crisis isn't over. It's just beginning. That night, the Federal Reserve goes into emergency session. Greenspan issues a statement before Tuesday's open, a single sentence that will become famous. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. It's Fed speak for we'll print whatever money is necessary to prevent total collapse. Tuesday is almost as terrifying, but for different reasons. The question isn't just whether stocks will fall further. It's whether the market will function at all. Banks are refusing to lend to brokerages. Brokerages are refusing to execute trades. The clearing systems are breaking down. The Fed makes good on Greenspan's promise. They pump billions into the banking system. They pressure banks to keep lending. They force the financial system to keep operating through sheer will and unlimited money. It works. Barely. Tuesday sees wild swings but ends with a modest gain. Wednesday is better. The immediate crisis passes. But the questions remain. What caused Black Monday? How did it happen so fast? Could it happen again? If you think Black Monday is ancient history, you're not paying attention. Every factor that caused the 1987 crash is present in today's markets. Only bigger, faster, and more dangerous. In 1987, portfolio insurance programs controlled $90 billion and executed trades in seconds. Today, high-frequency trading algorithms control trillions and execute in microseconds. These programs can buy and sell millions of shares faster than you can blink. They account for over 50% of all U.S. equity trading volume. The flash crash of May 6, 2010, was Black Monday in miniature. In 36 minutes, the Dow plunged almost 1,000 points, then recovered most of it. The cause? An automated algorithm that dumped billions in futures contracts, triggering other algorithms, creating the same feedback loop that devastated markets in 1987. Or August 24, 2015. The market opened down 1,000 points. Why? Circuit breakers, the safety systems installed after Black Monday, triggered on hundreds of stocks. But automated trading systems didn't know how to handle this. They amplified the panic instead of containing it. The safety mechanism became the danger. In 1987, the crash happened during market hours when humans were present. Today, most trading happens in microseconds, executed by algorithms with no human oversight. These programs can malfunction, interact in unexpected ways, create feedback loops, all before any human can intervene. Passive investing is the new portfolio insurance. Exchange-traded funds and index funds control over $20 trillion globally. These funds don't analyze individual companies. They just buy everything in an index. When money flows in, they buy. When money flows out, they sell. Sound familiar? It's the same mechanical, algorithmic approach that caused Black Monday. What happens when there's a panic and everyone tries to redeem their ETF shares at once? The funds will have to sell the underlying stocks. All at the same time. To a market with no buyers. It's portfolio insurance on steroids. We've learned the wrong lessons from Black Monday. The Federal Reserve's response, flooding the system with liquidity, worked. Markets stabilized. But this created moral hazard. Market participants now believe the Fed will always step in, will always prevent disasters. This belief has encouraged even more risk-taking, even more leverage, even more algorithmic complexity. The really scary part is the next crash might not be containable with liquidity. Black Monday was fundamentally a liquidity crisis. Markets seized up, but the underlying economy was fine. The Fed could print money and solve the problem. But what if the next crisis is different? What if it's combined with a banking crisis, a debt crisis, a currency crisis? We're building systems of enormous complexity with single points of failure. Just like portfolio insurance in the 80s, we're optimizing for efficiency and forgetting about resilience. And when these systems fail, they don't fail gradually. They fail catastrophically. Black Monday teaches us 3 lessons that matter more today than ever. First, complexity is fragility. The portfolio insurance strategies that destroyed $500 billion in wealth were created by brilliant people using sophisticated mathematics. But they had assumptions that proved fatally wrong under stress. Today's algorithmic trading systems, ETF structures, and interconnected global markets are orders of magnitude more complex. Second, speed kills. The reason Black Monday was so devastating wasn't just the size of the decline, but the velocity. Markets fell faster than humans could process, faster than institutions could respond. Today, we've made everything even faster. We've removed humans from the decision loop entirely. When the next crisis hits, it will be over before we understand it's happening. Third, safety mechanisms can become danger mechanisms. Portfolio insurance was designed to protect investors. Circuit breakers were designed to prevent crashes. But both can amplify panic under the wrong conditions. Every safety system has failure modes. Here's the thought that should keep you awake tonight. We don't know what will trigger the next Black Monday. It could be a geopolitical crisis, a cyber attack, a central bank mistake, a pandemic, or something completely unexpected, something that seems minor until it interacts with our complex, high-speed, algorithmic markets in just the wrong way. But we do know this. The next crash will be faster than 1987. It will be more globally synchronized. And it will involve systems so complex that even their creators don't fully understand them. The question isn't whether it will happen. The question is whether we'll be ready when it does. If this video made you rethink what you thought you knew about market crashes, if it changed how you see the risks in modern finance, then share it. These aren't abstract historical lessons. This is a warning about the world we're building. Subscribe for more deep dives into the financial crises that shaped our world. Because the only way to prepare for the future is to understand the past. And Black Monday's past might just be our future.